Assalamu alaikum. This is lecture number 15 of Global Business Management. The topic of today's lecture is foreign exchange market. We have three learning objectives for today's lecture. The first one is to understand the determining factors of exchange rate movement. The next one is to understand the exchange rate prediction mechanisms. And the third objective is role of a manager in controlling foreign exchange rate exposure. Okay, before we start our today's lecture, we quickly do the recap of the last lecture. In the last lecture, we had discussed about what is the foreign exchange market, and we had discussed this thing that foreign exchange market is used to convert the currency of one country into the currency of another. It provides some insurance against foreign exchange risk and the adverse consequences of unpredictable changes in exchange rate. There are two things. The foreign exchange market is used first of all to convert the currency of one country into the currency of another country. The second thing is to provide the insurance of foreign exchange risk that exists across the countries. When you convert the currency, of course we are talking about the international business, global business, where firms are going to operate across the border, where they are going to deal with the foreign currencies. And there is, of course, risk is associated with that foreign conversion of that foreign currency. The exchange rate is a rate at which one currency is converted into another. International companies use the foreign exchange market when there are four scenarios, four situations where international business use the foreign exchange market. The first one is the payments they receive for exports, the income they receive from foreign investments, or the income they receive from licensing agreements with foreign firms or in foreign currencies. Important thing to say is this is the first scenario where a firm has to deal with the foreign currency market. This scenario is when the firm has to receive the payments from foreign business. Foreign business can take the form of export or FDI, the return from the FDI, or licensing, payment from the licensing agreements, or all these payments, all these money that they are going to receive from the foreign operations, that would be in the foreign currency. The next scenario is when the international business has to deal with the foreign exchange market, is that when they pay a foreign company for its product or services in its country's currency. When they are taking services from the foreign country and they have to pay money against that services or products. For instance, a company is Chinese, Pakistani firm wants to buy some products, some parts of the production from the China. Then of course they have to pay to that Chinese firm in foreign currency. The third scenario is they have spare cash they wish to invest for short term in money market. For instance, if interest rates are higher in foreign locations than at home. The third scenario is when the company have the spare cash and they want to invest that spare cash somewhere, and the potential option for the exist in the foreign market is more lucrative. The option in the foreign market is giving more return compared to the option in the domestic market. In that case, firm has to convert that money, that for instance the Pakistani rupees, into the foreign currency so that they can invest their money. The fourth scenario is they are involved in currency speculation, the short-term movement of funds from one currency to another in the hopes of profiting from shifts in exchange rate. The fourth scenario is when a firm is intending to quick buy and selling of the foreign currency to make a quick profit. When they see this thing that the currency another currency is down and they will appreciate sooner in the near future, or going up, raise the prices, then of course that company can buy that currency for that moment and then sell it when the currency rate is increased. Okay, the foreign currency the forward exchange rate. Forward exchange rate are typically quoted for 30, 90, and 180 days in the future. The foreign exchange market provides insurance to protect against the foreign exchange risk. The possibility that unpredicted changes in foreign exchange rate will have adverse consequences of the firm. A firm that insures itself against foreign exchange is called hedging. To insure or hedge against a possible adverse foreign exchange rate movement, firms engage in foreign exchange. Two parties agree to exchange currency and execute the deal at some specific date in the future using a forward exchange rate. When a firm has to make some payment, for instance, that firm has to make payment in another currency, rather than they wait for that date and decide and they pay their amount on that spot exchange rate, what they do, they fix some exchange rate for the future, for that time in the future. For instance, a firm A in Pakistan may bought something from B in China or in USA. What they can do that rather than they bought some stuff from in the beginning of the month of May, and they are willing to pay the Pakistani firm. The firm A is willing to pay that amount in the end of the month. And what they can do, they can fix some fix that exchange rate for some later days, for the later period. It can be for the after 30. If they want to pay the amount after 30 days, they can pay that amount, and they can fix that amount, fix that exchange rate before 30 days before the payment. The spot exchange rate is a rate at which foreign exchange dealer convert one currency into another currency on a particular day, like we do in regular life when we go to some foreign exchange dealer, and they convert that money and we get the foreign currency. That's a spot exchange. They make a deal. They give that amount to us in a spot exchange rate. A forward exchange rate is a rate is used for hedging in the forward market. A rates for currency. Spot rate exchanges continuously depending on the supply and demand. Okay, forward exchange rate, important thing is used for protecting yourself against the fluctuation or uncertainty exist in a foreign exchange market. You never know what's going to happen in the future, and might be that currency will go up and you are going to lose. You have to pay extra money. In order to control that, in order to mitigate that uncertainty or risk, those firms engage in, and that risk lies on both sides. So that to mitigate that risk for both companies involved in some sort of foreign exchange rate. Okay, the next thing is on the other hand, spot exchange rate is determined on the supply and demand of that currency. If the supply is more, the exchange rate will go down, and if the demand is higher, then the rate will go up. Another term is the currency swap that we had discussed is the simultaneous purchase and sale of a given amount of foreign exchange for two different value dates. For instance, swaps involve between international businesses and their banks, between governments when it is desirable to move out of one currency into another for a limited period without incurring foreign exchange risk. Swap is a sort of a deal between two companies. For instance, a company, Pakistani company is operating also operating in USA, and they want to raise the money in dollars, and the US company is operating in Pakistan. They need money to expand the Pakistani business, and they need money in Pakistani rupees. What they can do, and the best thing is they can raise the money, they can raise the debt, they can get the debt from their home countries. Because why? Because if the Pakistani firm is going to raise the money from USA, they will charge extra interest rate, extra markup because of information asymmetry, and here that firm might be and that can get a loan at cheaper rate because of might be the lending relationship with the bank, might be the credit history, might be some other sources they are going to avail at the cheaper rate compared to if they raise the money in USA. So what they can do, and same goes for the US firm as well. And what these companies are going to do is, Pakistani firm is going to raise the money in Pakistan in rupees, and the US company is going to raise the money from US. And what they can do, they can later, and they go to the swap bank, and both companies swap their amount with each other. Pakistani firm is going to get the dollars from the US firm, and the US firm is going to get Pakistani rupees from the Pakistani firm, and in both companies will be benefited from this transaction because of the cheaper rate of borrowing. Foreign exchange rate is a global network of banks, brokers, and the foreign exchange dealers connected by electronic communication systems. If exchange rate quoted in different markets are not essentially the same, there would be opportunity for arbitrage. The process of buying a currency low and selling it high is called arbitrage. And important thing is, in arbitrage, these firms always these investors are looking for this sort of differences, and when they see there is some their quotations across the countries are not in line, they immediately start buying that cheaper currency from one market and start selling that currency in the another market. And they are looking after this sort of difference, and this is called arbitrage. Important thing is that this arbitrage, this difference appears and then disappears for a very short period of time. Within a few minutes it disappears, this difference, and within those minutes these investors make profits. Okay, one other aspect that we had discussed is the US dollar is considered as a vehicle currency. Vehicle currency is the currency which is used as a like for instance, the Swedish krona. If one Swedish guy wants to go to the Switzerland, and both countries have the different currency, not very famous currencies. Sweden has a Swedish krona, and Switzerland has Swiss franc. And what they can do, rather than converting from Swedish krona to franc, what they can do first, they have to, because these are the minor currencies, small currencies, what they are going to do first, the Swedish krona will be converted into the dollars, and then dollars will be converted into the Swiss franc. It is estimated that in this way this dollar is used as a vehicle currency. It is estimated that around about 80% of all transactions are done around the globe in dollars. Okay, today we are going to see the relationship between the prices and exchange rate. Prices and exchange rate have a direct relationship between each other. There is a positive relationship between the prices and the exchange rate. The law of one price states that in competitive market free of transportation cost and barriers to trade, identical products sold in different countries must sell for the same price when their price is expressed in terms of the same currency. Before we understand the concept of or the relationship between the prices and exchange rate, there is important another concept which is called law of one price. Law of one price says that if we buy some product in Pakistan, the price of that product should be the same in another country when we exchange that rate into that currency. For instance, if we buy one pair of jeans in Pakistan, and its cost is 1,000 rupees, and we convert these 1,000 rupees into the dollar, and we get the $10. And what we are going to see that when we go to the USA, the price of that same jeans should be $10. This is called law of one price. And consider the important thing is this concept of this theory, sort of, or this notion, this proposition has some assumption. The first assumption is there is no trade barriers across the countries, there is no transportation cost, and there are free markets, and that's why people can buy the same product on the same price across the countries. Next concept is purchasing power parity. Purchasing power parity is almost the same thing like law of one price, which argues that in relatively efficient market where there are only few impediments, this is not only the efficient market. In efficient market, like we discussed law of one price, there is no impediment, no obstacles in trade, in the flow of trade across the countries. According to purchasing power parity, the price of a basket of goods should be roughly equivalent to each another country. Basket of goods mean the basket which contains the basic products which are necessary for the living being. The cost of these products should be same across the countries. This is the basic notion, like the law of one price. But the main difference is that the law of one price has the assumption of efficient market where there is no transportation cost and no barriers, while the purchasing power parity has the assumption of relatively efficient market, which considers some sort of obstacle, some sort of impediment of trade across the countries. Okay, the prediction of purchasing power parity is if we find this thing that the prices across the countries are not compatible with each other. We cannot buy the pair of jeans from USA with $10. If we don't do that, if the price in USA is if it's $5, then that means prices are not compatible, prices are different. The exchange rate should be different as well. Exchange rate should be adjusted according to that change in prices of that products. A positive relationship exists between the inflation rate and the level of money supply. We all know this thing, that if the supply of money is higher in the market, then inflation will be higher as well. How? It goes like this: when the supply of money is high, people have more money in their pockets to buy the products. When they have more products, when they have more money to buy the products, but on the same time the supply of product in the market are not at par. Supply of money and the supply of products are, if they are not at the same level, then if the money is higher than the number of products in the supplied products in the market, what's going to happen? People have money but they don't have the product. What's going to happen? Demand of those goods will be increased, demand of those products will be increased, and the sellers will charge higher. When there is one product and there are many customers, what happens? The sellers, that shopkeeper, he is starting to demand higher prices. When he observes that there is more demand of that product, he is starting to just sell on extra price. Extra price means inflation. Inflation means supply of money has a positive relationship with the inflation. Okay, when the growth in the money supply is greater than the growth in output, inflation will occur. PPP theory suggests that changes in relative prices between the countries will lead to exchange rate changes, at least in the short run. A country with high inflation would see its currency depreciate relative to other. Like we are discussing about the example of the USA and the Pakistan. If the prices, there is some, we continue with the example of that jeans. In Pakistan, they are selling that jeans with 1,000 rupees, and in the US, the same jeans is the cost of same jeans is $5. What's gonna happen? That it shows that officially, logically, that price of that jeans should be 500 rupees here in Pakistan, because $5 equal to 500 rupees. Because of this concept, that we observe this thing, that we conclude that in Pakistan there is inflation. That's why the prices is higher. And because of this inflation, this PPP theory says that because of this inflation, the exchange rate should be adjusted. How it should be adjusted? The country which has the inflation, the currency of that country should be devalued, should be depreciated. In our scenario, Pakistani rupees, Pakistani currency should be depreciated against the US dollar because of this change in price, or because of this inflation factor. This is the basic theory of that's how we see the relationship between the price and exchange rate. If the price is higher, exchange rate will be go down. That will show a negative relationship, inverse relationship between the price and exchange rate movement. Empirical studies have tested PPP theory's predictions and suggest that it is the most accurate in the long run, and for countries with high inflation and underdeveloped capital markets. This is the basic studies. The finding of the studies is that it's okay in the long run, and in countries with the high inflation and underdeveloped capital markets, like in our countries. In other words, if a government suddenly decides to give everyone 1,000 to increase the supply of money stuff, the increased demand would encourage stores and the other providers of goods to raise the prices, which of course is inflation. The increased supply of currency in the economy would then cause the value of the currency to drop. Supply of money leads to demand, higher demand leads to higher inflation. Higher inflation will increase the buying power, and buying power will will depreciate the currency. Okay, then the question is it PPP, the prediction of PPP is working in short run or not? There are several reasons why the theory isn't accurate in the short run, including the fact that it assumes away transportation cost, trade barrier. There are a lot of assumptions underlying this PPP theory. That's why it's not really accurate in predicting the short-term exchange rate movement. And these assumptions are transportation costs, trade barriers, and controlled distribution systems, and the multinational companies that influence, the role of multinational companies that influence the prices, the role of government interventions in foreign exchange market. Okay, the next thing is the interest rates and the exchange rates. In countries where inflation is expected to be higher, interest rates are also will be higher because investors want compensation for decline in the value of the money. Okay, the next concept is we are going to see the relationship between the interest rate and the exchange rate. We know this thing, if the, like we had discussed the case of the inflation, if the inflation is higher in one country, then investor will demand a higher rate of return on their investments. That shows that inflation is directly proportional to interest rate. Okay, this relationship is formally proposed by Irwin Fisher and known as the Fisher effect, which states that a country's nominal exchange rate is a sum of required rate of interest and expected rate of inflation over the period of time. The international Fisher effect states that for any two countries, the spot exchange rate should be changed in any equal amount but in opposite directions to the difference in nominal interest rate between the two countries. In other words, it is stated that a spot rate of at the beginning of the period minus spot rate at the end of the period multiplied by 100 is equal to interest rate in first currency, interest rate in the nominal interest rate in two countries, I minus the nominal exchange rate of the another country. Okay, we see the inflation is expected to be higher, interest rate will be go higher, and in order to encourage investors to keep, okay, if there are no restriction in capital flow, and real interest rate must be the same everywhere. Now there is another concept. If there is no restriction across the countries in trade flow, what would be the result of this thing? There will be interest rate will be the same across the countries. In other words, if the real interest rate in France is 10% and US is 6%, what's going to happen? The investor will start buying from France and start investing in. People will start buying from the US and start selling in, investing in France, because the rate of interest is higher in France, and because the borrowing is cheaper in USA with 6%, that people will be more do the lending and borrowing in the US market. This would bring the value of a dollar up and consequently push the real interest rate in the US up. The opposite will occur in the France. So the international Fisher effect states that for any two countries, the spot exchange rate should change in an equal amount but in opposite direction to the differences in nominal interest rate between the countries. Okay, another factor which is really important in exchange rate movement is the investor psychology. In investor psychology is very important. Like people think it's a psychological term which is called bandwagon effect. It occurs when like if one person is doing something and other people believe this thing, that this person is going to make some profit and this person is really expert and his opinion, people start following this thing. Few people will follow. When the other people say, when other people see this thing, that a group of people are doing something, they will start following that thing as well. We have seen this thing that explicitly we can state this thing: when expectation on the part of traders turn into self-fulfilling prophecies, traders can join the bandwagon and move exchange rate based on group expectation. Government intervention can prevent the bandwagons from starting, but it's always effective. But important thing is that this bandwagon effect appears when a group of people start doing something and other investors start following that approach, and the entire market start doing the same thing, and which changes the exchange rate across the countries. And government can intervene this thing to stop the bandwagon effect. Okay, now we have seen this thing that the companies are facing the exchange rate movements, and companies have to face this sort of uncertainty that they have to bear. They are operating international businesses, they have to operate in the different currencies. Now there is another term, there's another very common practice in the foreign exchange market, is the prediction of foreign exchange movement. For predicting, and the question is whether firms need those sort of predictions, or we can put alternatively that whether firms need those predictors, those services, those people, those companies who predict the foreign exchange movement. There are two schools of thoughts who explain this need of services. The first one is the efficient market schools. This argue that forward exchange rate do the best possible job of forecasting future spot exchange rate, and therefore investing in forecasting software would be a waste of money. The efficient market is the price reflects the available information. Okay. The first school of thought is the efficient market school of thought, which says that the forward exchange rate is the best prediction of the future exchange rate, and there is no need to pay money to the external people and buy that service from those companies, because in efficient market the prices reflect all available information in the market. If the foreign exchange market is efficient, then forward exchange rates should be unbiased predictors of the future spot rates. When a company need to predict the future spot rate, what they have to do according to this school of thought. If the market is efficient, then the rate of exchange between two currencies should reflect all the available information in the market. Most empirical tests confirm the efficient market hypothesis, suggesting that companies should not waste their money on forecasting services. Meaning, this school of thought prohibit availing the facilities or taking the facilities from those companies who are predicting the future spot rates. On the other hand, there is another school of thought which is called inefficient market school of thought, which argues that companies can improve the foreign exchange market's estimate of future exchange rates by investing in forecasting services. The second school of thought is the inefficient school of thought, in which prices do not reflect all the information on the exchange rate across the two currencies. Between those currency rate, it says that the inefficient market is inefficient, and that market is not showing the exact information of that of market in the exchange rate between two currencies. What the companies have to do in order to deal with this sort of predicament, what they can do, they can hire the services from the forecasting services from the external companies. In an efficient market, forward exchange rate will not be the best possible predictor of future exchange rates, and it may be worthwhile for international business to invest in forecasting services. However, the track record of forecasting services is not so good. But important thing is, despite that, inefficient market school of thought suggest and recommend companies, international businesses to buy these services from forecasting services, but on the same time they say that the track record of forecasting services is not so accurate. Okay. There are two schools of thought of forecasting exchange rate. The first one is two ways how they are going to predict the future exchange rate. The first one is through the fundamental analysis, which draws upon economic factors like interest rate, monetary policy, inflation rates, and balance of payment information to predict the exchange rate. The first analysis, the school of thought says that companies can predict the future exchange rate through macroeconomic variables, through economic factors like interest rate. Like we had already discussed, there is an inverse relationship between the interest rate and exchange rate. If the interest rate is higher within certain country, then of course the exchange rate will go down. And interest rate is higher mean the inflation is also higher, because we have learned this thing that in a country where inflation is higher, the investor will demand higher return on their investment. Otherwise, they will go to some other country. And next thing is monetary policy. Monetary policy is the supply of money. If the supply of money is higher, inflation will be higher, interest rate will be higher, and consequently the the exchange rate will depreciate, it will go down. And these things directly we can totally understand this thing, and we can see the pattern, the history with the data of those macroeconomic variables in the previous years and the quarterly, that how the country's interest rate, inflation, monetary policy has changed, and in what direction the change have occurred. And in that way, these fundamental analysis can predict the future exchange rate movement. Another is the balance of payments. Balance of payment is if the country is going in deficit or in surplus. This is also an important thing. If the country is going in deficit, of course this will affect negatively on the exchange rate, and if it's going in surplus, it affects positively on the exchange rate. The next one is the technical analysis. Technical analysis charts tends with the assumption that the past trends and the waves are reasonable predictors of future trends and waves. The technical analysis is checking the past trends of that exchange rate between two countries, and checking that if with the previous record they are predicting for the future one. If it happened since might be the 2-3 years it's going in this direction, then they predict that in the future it will go in the same direction. We have seen this thing in our surroundings. Some currencies are easily convertible to another and some is not. Scholars have categorized this conversion of currencies into 3 categories. The first one is the freely convertible currencies, the next one is externally convertible, and the third one is non-convertible currencies. The first one, the currency is freely convertible when a government of a country allows both residents and non-residents to purchase unlimited amount of foreign currency with the domestic currency. This is the first case, when a government allows its residents and non-residents. Now, who are non-residents? Might be the expatriates, people who are living, might be doing job in the foreign companies or in our country, but they are foreigners. And the second thing is might be the investors, who are the companies. They can invest, they can buy foreign currency. They can, for instance, in Pakistan, anybody can buy the amount of dollars or pounds, and these companies, local residents, and these foreign companies, the foreign non-residents, they can buy any amount of dollars or pounds or euros. The next one is the externally convertible, when only non-residents can convert their holding of domestic currency into the foreign currency, but when the ability of residents to convert currency is limited in some way. Mean that in the second way, in certain markets, only the non-resident people who are not the resident of this country, like the investors, the companies, the foreign companies can, for instance, some foreign companies operating in, for instance, US companies operating in Pakistan. What they can do, they will be under this market. If we are externally convertible market, what's going to happen? Those foreign companies are allowed, because they are operating in Pakistan, of course the money that they are generating, it would be in the Pakistani rupees. They would be allowed to convert the rupees into US dollars, and simultaneously the local residents will not be allowed to convert the Pakistani rupees into dollar, or if they are allowed, that will be only in a limited amount. So that would be some restriction. A currency is non-convertible when both residents and non-residents are prohibited from converting their holdings of domestic currency into the foreign. The third scenario is when the non-convertible market. Non-convertible market would be the such market where neither the residents nor non-residents are allowed to convert the local currency into the foreign currency. Okay, let's talk about the Pakistan. In Pakistan, sometime the policy changes. In certain time, we directly fall into the externally convertible market, where non-residents can buy the amount of foreign currency whatever they want, and however much they want to buy, they can buy the foreign currency in Pakistan. But the local residents, they are allowed with some limitations. There are certain amounts they cannot more than that amount they cannot convert the Pakistani rupee into the foreign currency. And in the third case, like a non-convertible, this is the typical case of the former Soviet Union and the countries former Soviet Union, and nowadays we have this example of North Korea that comes under non-convertible markets. Most countries today practice free convertibility, although many countries expose some sort of restrictions on the amount of money that can be converted. Countries limit convertibility to preserve foreign exchange reserves and prevent capital flight. Why countries limit convertibility to preserve foreign exchange reserves and prevent capital flight? Mean why they want to stop residents or non-residents to buy the foreign currency. Why they do that? This is the reason. When residents and non-residents rush to convert their holdings of the domestic currency into a foreign currency, the supply, the balance, and we can say the supply of currency will be disturbed. We had discussed this thing that if the supply will be reduced, what's going to happen? The interest rate would go down, inflation will go down, and people have less money in their hands, and the prices will go down. But there will be a trade deficit and the exchange rate will go up. When the exchange rate will go up, what's going to happen? Pakistani currency will go up. That's mean. And when the Pakistani currency will go up, what would be the trouble? People, the companies companies who are buying the Pakistani products from the other markets, they will stop buying this thing. They will find our products more expensive. That will be the trouble, and our level of export will be reduced. In that way, our current account will be in deficit, and this is not so good when supply of local currency will be reduced. And this term, when we say this thing, the supply of local currency is reduced, is called capital flight. When a country's currency is non-convertible, firms may turn to the counter trade, barter-like agreements by which, okay. The third point is when in markets where these companies are not allowed to convert their currencies into the foreign currency, what they do, they continue their businesses there, but they try to do some sort of a counter trade agreements with the local companies. Like if a US company, just imagine Pakistan is the country where currency is not allowed to be converted by foreign and by non-residents, or residents or non-residents, both of them, they cannot change the currency, Pakistani rupees into the firm. What they can do, if a US firm is operating in Pakistan and they are making money in Pakistani rupees, but they cannot convert their rupees to the dollar and they can take back that dollar to their home country, what they can do, they are going to make some agreement with some other firms who are going to take their products into and in return they are going to give some other products to the US companies, or they are going to give some products to their back home. And important thing is then they are not going to trade with Pakistani rupees. They are not trying to hoard the Pakistani rupees. Rather, what they do, they will do some trade with products. Okay, what is the role of managers in foreign exchange market? The managers need to consider three types of foreign exchange risk. The first one is the transaction exposure. There are three types of exchange rate risks, and these companies the managers have to understand these risks. The first one is the transaction exposure, the extent to which the income from individual transactions is affected by the fluctuation in foreign exchange value. A firm has a transaction exposure whenever it has the contractual cash flows receivable. Okay, transaction exposure. How we explain the transaction exposure? A manager should be aware of this thing, that when a company is going to receive and deliver some money in terms of foreign currency, they are going to face the receivable and payable. Their cash flow is going to be affected because of this trade flow. Values are subject to unanticipated changes in exchange rates due to the contract being dominated in the foreign currency. Okay, the next exposure is the risk that managers are going to face is the economic exposure. Economic exposure is exposure when firms are going to they will be exposed because of the change in economic situation across the country, and that change in economic situation will affect on the exchange rate in that country. Such exchange rate adjustment can severely affect the firm's market share positions with regard to its competitors, the firm's future cash flows, and ultimately the firm's value. Concerned with the long-term effect of changes in exchange rate on the future prices, sales, and cost. Important thing is economic exposure will affect. For instance, just take an example. If there is some trouble, if there is some Pakistani firm who has some investment in Iraq or some Syria or some, we can say some country like this. If they have the investment there, and before like just imagine the scenario like regime is changed or some economic sanctions are imposed on that country, but what going to happen to the Pakistani firm? The operation, they will continue the operations there, but because of the foreign exchange rate is changed in that country, overall value of that company in the market, when the investor are going to evaluate the overall foreign assets of that company, they will evaluate in a low price. So overall it affects on the value of a firm. While on the transaction exposure means that when firms have to do some receivable or payable, when firm has to take some money or give some money, then at that time exchange rate movement will affect on this cash, receivable or payable. A firm's the third one is translation exposure, is the extent to which financial reporting is affected by exchange rate movements. Translation exposure is the impact of currency exchange rate changes on the reported financial statements of the company. As all firms generally must prepare consolidated financial statements for reporting purpose, the consolidation process for multinationals entails translating foreign assets and liabilities and financial statements of foreign subsidiaries from the foreign to domestic currency. This is the third sort of exposure. It is concerned with the present measurement of the past events. It gains or losses or paper loss, they are unrealized. Many American companies with operation in Europe were able to benefit from the translation exposure between 2002 and 2004 when the rising euro increased dollar profit. This is the main exchange rate with effects on the financial reporting system. Financial reporting, when they have to report their firm value and when they have to report the value of their total assets, market capitalization, these things will affect on their, when the exchange rate will be different, when exchange rate will be increased or changed, these things will affect on financial statements of that company. And it has like we have said this thing that in 2002 and 2004 when the rate of euro increased, a lot of American companies who were operating in Europe, they were able to benefit from this translation exposure. Okay, we have seen what are the different exchange rate risks. Now let's talk about how managers can control or mitigate these risks. There are several ways to minimize the transaction and translation exposure. Managers should buy forward, use swaps, and lead a lag payables and receivables. Buy forward mean they can fix some exchange rate for the future spot exchange rate. They can fix this thing. The next thing is they can swap. They can use the swap rather than indulging themselves in the foreign exchange rate they are dealing. What they can do the swap. Swap mean if Pakistani company Pakistani company is operating in USA and USA company is operating in Pakistan, Pakistani company wants to bring back its dollars into the this dollar to the Pakistan, and Pakistani company, this US company that wants to bring back this Pakistani rupees, that profit which they make in the Pakistani market, to back to the USA. What, rather than converting these for these currencies, what they can do the swap, and they can Pakistani company can deliver the US dollars what they make in the US market. They can give the Pakistani rupees. They can receive the Pakistani rupees and give the dollar to the US company. In that way, they can make a deal. They can swap their currencies. And the next one is a lead and lag, payables and receivables. Lead strategy attempts to collect foreign currency receivable early when a foreign currency is expected to depreciate, and pay foreign currency payable before they are due when a currency is expected to appreciate. Okay. The first strategy, lead strategy. In the under the lead strategy, foreign currency receivable, the manager should receive the foreign currency before it started to depreciate, and pay the currency when it started to depreciate. Okay, the lag strategy, delay collecting of foreign currency receivables if that currency is expected to appreciate, and delay payables if the currency is expected to depreciate. Okay, lag mean lagging behind. What they can do, they can delay their foreign currency receivables. If they have to receive some money from the other companies, they can delay that receivable if they think that currency is expected to appreciate. If they believe this thing, the foreign currency is going up, and they have to take money from that company from in that currency, of course they are going to get a smaller amount because of this appreciation. What they can do, they can delay that thing, delay that receivable. And similarly, they can delay payable if they have to, if they see this thing, that their currency is depreciated, or in near future is going to be depreciated, and they have to pay that some amount of money in the foreign currency. They can delay payables if the currency is expected to depreciate. Lead and lag strategies can be difficult to implement. Why? These strategies are difficult to implement because when managers of company A tend to doing this sort of strategies, they are following this strategy, of course the company B is going to do the same thing as well. Then who is going to, for instance, in the lag strategy, delay collection of foreign currency receivable, if the currency is going to be appreciated, manager of the company A will say, oh, we are not going to take the money now, we are going to take money after 1 month. But what you say about the manager in the company B, they are going to say, oh, we are going to pay right away. Then that would be a deadlock, or that will be a conflict between the two managers. They want to pay earlier, and they want to receive in the future. They want to delay the receivable, and in that way it's really difficult to implement. And another way is managers can reduce the economic exposures by distributing productive assets to various locations, so that the firm's long-term financial well-being is not severely affected by changes in exchange rate. They have to divide they don't need to put all the eggs in one basket. They divide their assets in various locations, so that if the economic exposure, economic change occur in one country and which affects the foreign currency, that should not affect to all the investment of that company. The next one is ensure assets are not too concentrated in countries where likely rises in currency values will lead to damaging increase in the foreign prices of the goods and services. Okay, they should avoid investing. They should avoid those countries where the this sort of economic exposure, risk of economic exposure would be higher. The company should avoid this sort of investments. Okay, in general, what managers should do, the first of all, have a central control of exposure to protect resources efficiently, and ensure that each subunit adopts the correct mix of tactics and strategies. This is the first thing. They have to, first of all, they have a central manager should have a central control to protect resources efficiently, and they should make sure this thing that all the subunits are well prepared and they are adopting the same tactics and most efficient strategies which might be dictated by the main headquarters. The next one is they distinguish between the transaction and translation exposure on the other hand, the economic exposure on the other hand. On the one hand, they should distinguish between, and they should be aware of the transaction and translation exposure, but on the other hand they should be well aware of the economic exposure as well. The third one is attempt to forecast future exchange rate. Managers should be able to forecast the economic exchange rate. How they should do that? They can do on the basis of the macroeconomic data, or they can do either the fundamental analysis or they can do the technical analysis. Establish good reporting systems so the central finance function can regularly monitor the firm's exposure position. That's a very important thing. They should have a reporting system, should be central finance function, that reporting system should include all the subunits, whatever they're going on there in the foreign sites. They should know this thing, and they regularly monitor the firm's exposure position. This is a very important thing. If the managers know the firm's exposure position, they can take step and they can avoid those risks in due time. Procedure. Okay, the last one is the produce monthly foreign exchange exposure report. That's another thing. They should produce a foreign exposure reports, foreign exchange exposure report on the monthly basis. And the second thing is they can communicate this sort of exchange exposure reports across their subunits. Okay. Now we do the summary of today's lecture. Today we have done about the law of one price, what it states. We have done this thing, and we have discussed about the purchasing power parity, and and the next thing we have seen in law of one price and purchasing power parity, we have seen the impact of our relationship between the price and, or we can say the inflation. We have seen the relationship, the inverse relationship between the price and exchange rate. Then we have seen the Fisher effect and international Fisher effect, and which states that for any two countries the spot exchange rate should change in an equal amount but in opposite direction to the differences in nominal interest rates between two countries. And then we have discussed about the bandwagon effect, how it happens. And next we have done the purchasing power parity, which argues that given relatively efficient markets, the price of a basket of goods should be roughly equivalent in each country. And this relationship is formalized by the Fisher effect, which states that a country's nominal exchange rate is the sum of equivalent amount of interest and the expected rate of inflation over the period of time. There are two types of school of thought. One about school of thoughts about the which have some stands, some sayings, whether firms should avail the forecasting services or not, should invest money in forecasting services or not. The first one is the efficient market school, which argues that the foreign exchange rate do the best possible jobs of forecasting future spot rates, and therefore investing in forecasting services would be a waste of time. Efficient market, on the other hand, says that prices reflect all valuable information. Okay, the inefficient market school argues that the companies can improve the foreign exchange market, estimate the future rates by investing in forecasting services. Fundamental analysis. Fundamental, there are two types of analysis to predict the exchange rate. The first one is the fundamental analysis. The next one is the technical analysis. Fundamental analysis is based on macroeconomic variables. The technical analysis is based on previous trends. Okay, currency is freely convertible. There are three sort of currency conversion markets or environments. The first one is freely convertible. The next one is externally convertible, and the third one is non-convertible. Okay, the freely convertible, in that market, the resident and non-residents are allowed to convert their currencies, and in externally convertible, only the non-residents are allowed. And in non-convertible, both residents and non-residents are prohibited from converting their currencies. Okay, what the managers should do under this such sort of risk? They should buy forwards, use swaps. They lead and lag payables and receivables. And what is the lead strategy? Attempts to collect foreign currency receivable early when the foreign currency is expected to depreciate, and pay foreign currency payable before they due when a currency is expected. And similarly, delay collection of foreign currency receivable if that currency is expected to appreciate, and delay payable if the currency is expected to depreciate. Important thing is, in both strategies, lead and lag strategies, they are very difficult to implement because there will be a clash between the intentions of the managers across the companies. Okay, thank you for today's lecture. Allah Hafiz.